Deflation, probably your only real safe place is going to be in government-related paper or really good quality corporate or muni paper. But there's a lot more danger on the bond scene now, either in the inflationary or deflationary scenarios, than there has been through the better part of the last 3 decades. I mentioned a few minutes ago that we warned about valuations. See on the next page, I think I've said many times, this is one of the best history on a page type graphs. We warned about severe overvaluation at the end of the 1990s. We didn't call it a bubble. We simply said this makes no sense. And you can see the ridiculous level of valuations. First of all, this is the point, this is just about the end of the 90s, just into 2000. And you can see, that's lettered, and you can see what the valuations were. The first 3 numbers here, I wouldn't pay as much attention to bill and rate, note rates. But if you look at the first 3 valuations, that's PB is price to book, 5.0. You just look up the column. It's all the other peaks or troughs. There's nothing close to it. This was by far the highest valuation. Price to dividends, second column, 89.4. There was no comparable. Price to earnings, 29.4. There was no comparable. We were looking at levels of valuation that made no sense. And we said that loud and clear. At the same time, you remember the dot-com bubble was in full bloom, and most people didn't want to hear it. They said, yeah, we understand, a lesson of history is a great thing. It's a new era. It's different this time. Of course, it turned out not to be different this time. Those who were at our conference in February of 2000, so a decade ago, we talked at some great length. I laid out pages of data on a couple of hundred high-tech companies, talking about their valuations and a variety of other things. Essentially saying, though these were, or at least included in that couple of hundred companies, these were the most respected technological names of the day, and essentially said, this makes no sense. I know there's a few great companies in here, but this makes no sense. And that was just about at that market peak. The market then, of course, came down tremendously. Many of the tech companies that were great standards of the times died, and of course the stock market itself declined anywhere between 50 and 80%, depending upon which indexes you were looking at. If you look over to the next page, besides absurd valuations and tech stocks trading in fantasy land, we highlighted at the time in virtually every talk we gave the huge danger that existed because of unprecedented levels of debt. This is total credit market debt in this country as a percentage of the economy as measured by the gross domestic product. It is a ratio. So if debt were going up at the same rate that the economy were growing, it would be a horizontal line. It obviously isn't. From about 1980, is that? No, that was 1950. This is 1980 over here. The debt relative to the size of the economy just exploded. And obviously it became a growing danger. We made that point over and over and over again. We first started to warn about it really when just about the end of the 90s, when it broke above the Depression era ratio. And we made the point we're in uncharted waters. The only other time we got up even close to that, it ended in tears, as a great amount of the debt was deflated and defaulted away. So we were saying this is a growing problem that will probably not end well, though we have no way to know how high it might go. What's also interesting to note over on page 8 is that as the debt grew, the growth rate of the economy declined. This is a 10-year total of GDP growth. So this is how each spot on the line measured, you can see the percentages over here, is how much the economy has grown in the prior decade. And you can see just about at 1980, just about when the debt was taking off. This is a different version of what we saw on the prior page. Just as debt was starting to really go up at a rapid rate, our ability to grow, or the rate of our growth, started to a very disastrous decline. And where we are right now is that it takes increasing amounts of debt to provide and produce each new dollar of gross domestic product, the GDP. We've compounded the problem of growing debt with what we see on page 9. This was another of our common themes. Notwithstanding Warren Buffett's fairly active use of derivatives right now, we frequently quoted his characterization of derivatives as financial weapons of mass destruction. And in fact, derivatives proved to be just that. I mean, we saw they played a critical role in the crisis that nearly brought down the entire financial system, that nearly destroyed the banks. And what we've done, we've darkened the two lines in here. This was the peak of year 2000. This was the peak in year 2007. And despite their destructive tendencies, derivative totals continue to grow, which somewhat blows my mind. Now this graph really sums only the derivative ownership at U.S. commercial banks. The total notional derivative amounts throughout the world are more than twice this number. What amazes me is, though there may be a number of legitimate uses for derivatives, the vast bulk of derivatives are pure gambling chips. They do not represent an offset, a hedge to anything. They're another tool with which to gamble. We haven't seen them regulated yet. We're seeing the politicians pussyfoot around this because this is a big profit item to Wall Street. To underwrite and market derivatives is a big part of Wall Street's profits. And so destructive as it already has proved to be, it's hard to get politicians who want to be reelected to really push hard for regulation of something that is screaming for improved, I wouldn't even say improved. I mean, you got to have some regulation. You can't just write these things in a closet with some friend and then tie up the whole financial system where things can break down because we don't know even who some of the counterparties are. It's a shocking arrangement, which I do hope will get cleaned up. In mid-decade, we began to talk about household vulnerability. You'll see over on the next page here. Besides highlighting the growth in debt, we pointed out that households were saving less and less each year as each year went by, and this graph was the result. This shows household liquidity. Basically, how much relatively free or near free cash did each household have relative to the size of the household's liabilities. And you can see a very clear trend, obviously. And our point was, people had gotten so confident because business growth had been so consistent that they felt there was no real need, and by the way, their homes were growing in value. There was no real need to save. And we said, this is a disaster waiting to happen. Recessions are inevitable. Accompanying virtually every recession is a significant growth in unemployment. We've got a bunch of people in this country who haven't provided for that rainy day. There's an inevitable crisis awaiting when we get the recession, more people are unemployed, and of course, what did we see? A recession came, it happened to be fairly serious, unemployment became big, and people lost their homes because they had no cushion. They lost to foreclosure. So there are certain things that appeared obvious. I just wondered, why were we not hearing warnings about this throughout the decade? Everybody just assumed a great level of confidence.